Okay, what we're going to be looking at is monetary policy today, and basically this is the Fed. We're going to do two different policies. I do monetary policy before I do fiscal policy, and we're going to look at how the government regulates the availability of money and how much is credited into the economy and how it deals with our economic instability or stability. So there are three tools of monetary policy. One we've just dealt with the math, right? The reserve requirement. We saw the lower that percentage was, like 5%, what happened to the money in the expansion? It went up. The higher that percentage, what happened to the money in the expansion? It went down. And that is when the Fed, they look at banks and they say, look, this is the money that you cannot lend out. That is the money that they must keep in the banks full. That is required by the Fed. Okay, so do y'all get this tool? The next one is the open market operations. This is done by the FMOC, the Federal Open Market Committee. And what they do is they buy and sell government bonds. So, let me just get a little piece of paper. This is a bond. And this is basically the government. Y'all remember in World War I and World War II, the government sold a lot of these, right? And so a lot of Americans being very patriotic because they couldn't buy stuff in the war and they were encouraged to buy these war bonds, they're going to give their money to the government, right? And the government gives them this bond. And this is just her money. I'm just taking all her money from her, okay? Now, what has happened to the money supply that she bought that bond? The money supply has gone which way? Down. Well, when she gives that bond back to the government, what is the government going to give her? Money, which has happened to the money supply. It went up. And so this is another way the government manipulates the money supply. If they issue these paper things, they could, and they issue it to y'all, and the government takes your money, the money goes down. Okay? If they buy this from you and they give you the money supply goes up. This is one of the most often used tools that is done by the government to manipulate the money supply. Okay. The next one is the discount rate. The discount rate is the interest rate that the Fed charges member banks. So do y'all remember when Hurricane Harvey hit in Houston? It was like 2 years ago, right? So did people want to have their debit card on them, or would they want cash? Why did they want, think about Harvey. What did Harvey do to the electricity? It took it out, right? So would they be able to use their debit cards? So they wanted to have what? So then everybody went to the banks, right? They went to their ATM. And they try to get all of their money out. By what we know of the reserve requirement, did the banks have to have all of that money on hand? But people were coming at them, right? They wanted their money. Did the banks have to fork over that money? So this is why they'll go to the Fed and they're like, look, we need a loan. We have overextended ourselves. We have loans because we loaned out our excess, which we were allowed to. But we are in a dire situation, right? It's an emergency situation. And the Fed, what they do, they're like, okay, we will extend you a loan. And now they have that money. Can they meet their depositors' demands? And so they have that money and everybody gets to take out their money. But you get the discount rate. The Fed lets people borrow from them or other banks in times of a crisis. Because when crises happen, do people want their debit cards? No, they want to have the cash on hand. And so the discount rate is the interest rate that banks charge each other, and also the Fed charges its member banks. So there's some minor tools. The unofficial pressure by the Federal Reserve to try to change the economy. This could be through press releases when they're saying that things are going well in our economy. Or we could have the Securities and Exchange Commission. They're the people who are, and we talked about them last year being created in the New Deal by FDR, that they go out there and they oversee what is going on in the stock market and they assure that the soundness of those stocks. So our government runs two policies, okay? In a contraction, what do you think is happening to the money supply? It's going down, right? So what do they need to do with the money supply? Increase it. So the government is going to look at our problem. First off, there's unemployment, right? People don't have money because what has just happened to their jobs? They lost them. And so what the government's goal to do is to increase the money supply. So the reserve requirement, are they going to have a high reserve requirement? No, they're going to have a low one, like 5%, right? Because the lower that reserve requirement is, what can happen to the money expansion? It goes up, what we just did in that table. So the reserve requirement, they're going to decrease it. More money will be available for loans because of that excess reserves. And we're going to see more loans will create more money in the economy because banks will loan those to businesses. Businesses will employ people, and people will not have jobs. What are they going to have in their pockets? Money so that they could do what? Spend. The other thing is the discount rate. They're going to decrease it. They're going to make it cheaper for banks to get loans. And then in the open market operations, the government takes these bonds that you have, right? And they buy them. And what does that give you? More money. What has just happened to the money supply? And the way I remember what they want to do in this is down, boy, down. Decrease the reserve requirement, boy, buy, and decrease that discount rate. Okay? Do y'all get how they just increased the money supply? Okay? Eventually, we're going to look at this. We have a reading over this. Okay? This was what I was saying I was going to get to. By decreasing that reserve requirement from like 25 to 5%, what has just happened to the money supply? Gone up, right? So looking at this, this is my money market chart. This is the interest rate right here, which looks different, right? We usually had price on this side, price level. Over here is just the amount of money in circulation, okay? Do my curves look like my typical curves? Does my demand curve look like a demand curve? Yes, right? Because when interest is high, do you think we want to take out those loans? When interest is low, do we want to take out those loans? Okay, my money curve, that looks quite weird, right? It's vertical because you have to understand, is the supply of money constant at a moment? Yeah. Think about, can I increase my supply at one moment instantaneously? No. So my supply is constant. This is the amount of money that there is. A matter of fact, so it's always going to be a vertical line. So just by what the government did, when the Fed came in and reduced that reserve requirement, what happened to the money supply? It went which way? Up. When they buy these bonds, right? She has the bond, right? When they buy the bonds, what do they give her? Money. What happened to the money supply? It went up. When they reduce that discount rate, which banks are now encouraged to get loans, what happens to the money supply? So then which way do you think the supply of money curve is going to go? To the right or to the left? To the right. And so this curve moves to the right, but look what just happened to the interest rate. What happened to the interest rate? It went down. You as a borrower, do you want to borrow now that that interest rate is lower? So now does this encourage more people to get involved in the economy? So now my economy, that was, if I could draw this, right? Y'all said our economy was going down, right? And our government decreased that reserve requirement, right? They buy bonds, right? And they reduce that discount rate. What did it cause with the money supply? Money supply increased, right? So now do you as people have money in your pocket? So what are y'all going to do with that money in your pocket? So what happens to the economy? This policy causes the economy to go into what phase of the business cycle? What is this upward phase? The expansion. And if they use these tools correctly, it will cause our economy to come up because what do you have in your pockets? And that was all done by reducing the discount rate, buying those reserve requirements, reducing that discount rate. Okay, now a tight monetary policy or money policy is done in the expansion phase. We know in this part of the expansion, do y'all have money in your pocket? And y'all have so much money that what are y'all doing to price? Y'all have so much money. What are y'all doing to price? You're increasing it. Remember that we call this demand pull inflation. Y'all have so much money. Which way is that demand curve going? So what is happening with the price? It was right here, right? What is happening to the price? Increasing. That's demand pull inflation. And that always happens in the expansion. Our problem is inflation, demand pull. So our goal is to reduce this money supply, so what will happen to your demand? So what the government does, we need to reduce the money supply. When we did that chart, what do we do with the reserve requirement to reduce the amount of money being expanded? We increase it, right? So we increase the reserve requirements. That causes banks to have less money that they can loan out, right? They're having to keep more on hand. So less loans mean less money being created. So that will decrease the money supply. The next thing is the discount rate, that interest rate that the banks charge each other. We will increase it. And now the next thing is this bond. Instead of buying it, the government's going to go to her and what? Sell it, and what are they going to take from her? What just happened to the money supply? So the way I remember this one is, I think International Sports Illustrated. Increase the reserve requirement, sell those bonds, and increase that reserve requirement. Because what are we wanting to happen to that money supply? We want that money supply to what? Shrink, right? And so there's your pins back. Which way is this? If they increase that reserve requirement, right? There's less money out there. If they sell her that piece of paper, they're taking her money. And if we increase that discount rate, it becomes more expensive, right? So which way should this supply of money curve go? To the left. And let's look at what impact this has on the interest rate. Oh, what happened to that interest rate? Do you want to borrow now? So what happens to your demand here? It goes down. Did they just deal with demand pull inflation? Okay, so there's just two different ways that we dealt with the effects of aggregate demand. One was tight monetary, okay? And then the other one was easy. So sometimes they're called tight is expansion, contractionary, and easy is expansionary, but we'll look at that. And they fight different problems. There is limitations to monetary policy. There are limitations. And so you would think, right now, I just went to two different policies, right? When should the government run tight? When we are in a what? Expansion. Do you think our government is running this right now? No, they're actually running easy. Wait, they're making it easier for us to get money. Is that causing more inflation? Yeah, they're running the wrong policy. So we're going to look at how this creates problems.
Ms. Virginia, you should be president.
No. Okay. Economic forecasting is not exact. Human behavior is not always predictable. The Fed may lower the discount rate, causing the interest rate to decrease, hoping that it would increase the loans. But people may not respond and get that stuff out there. Again, we see that sometimes people don't act as we expect them to. There's timelines. Within monetary policy, it does take time for stuff to get through, like the reserve requirement, the discount rate. The easiest one for them to do is the buying and selling of bonds, because that happens overnight. We're going to see the Fed does not always have to get approval of Congress and the president. And so sometimes the Fed is working one policy and fiscal policy is doing another thing. And so they may be doing the opposite of each other, which means there will be no impact. It can't fight stagflation, which we've talked about, which is high inflation and high unemployment. Last thing, it's not coordinated with our government policies. So the guy who came up with this is Milton Friedman. He believed that monetaryism, that we could come in and affect the money supply. If we allow more money to be out there, that would cause people to react to it. And so he says it doesn't matter, because the overall state of the economy will be impacted if people react to the money. And so basically, he died, Milton Friedman, but he's going to be one of the main people that helps us. I'm going to pass this out, and I'm going to go over the Fed. Yes? Okay. What? did y'all just understand what I did? Yes, no, maybe. So this is something we're gonna be spending time on. Okay. So, before I make it, we're gonna do a reading, but before I do the reading, I wanna explain the Fed, because you're just like, what the heck? And I have a video on the Fed that we'll watch in a second. This is the lecture. Okay, so we're gonna look at the Federal Reserve System that is doing all of the stuff what we saw. Let's put up the phones with the discount rate, the reserve requirement, and selling of bonds. The Federal Reserve was created in 1913. We saw this under the Wilson administration. It was supposed to deal with the panics that we've seen because of the lack of gold. It is our first nation's central bank, but we've seen banks before this. Do y'all remember Andrew Jackson? What did he do with the Bank of the United States? He wanted to get rid of it because of all of those wildcat speculation stuff. So this one will be the true, real central bank since Andrew Jackson had cut that other one. It does a couple of things. It serves as the government's payment person. So I don't know how many of you are going to file your income tax. Have y'all done that already? No. No? Oh my gosh. How do you work?
I don't know.
You got your W-2s? Okay, most of you should have gotten your W-2s back. And then if you're doing all this other stuff, you should be able, I have to do ours this weekend. And what will happen is if you've overpaid the government, they need to pay you back. And you'll get something from the Federal Reserves, which is going to be from the Treasury Department, which pays you back what you've overpaid. They also provide services to banks. Remember when I was explaining Harvey and how some of the banks didn't have enough money that they called up the Fed and the Fed says, we will rush you that money? They provide service to bank, and they also regulate the money supply. They make sure that the banks are keeping what they need to have on hand with that reserve requirement. So this is the structure of the Fed, and we're gonna watch a video on this. There's Board of Governors who basically conduct the policy. They have an advisory council to the president, and they deal with the open market operations, the buying and selling of bonds. Last year, I showed you a map of this. The 12 regional reserve banks. Remember how we pulled out our dollars last year and we looked? I think I actually have money today. So I had to go, no, I have to pay someone today, because we're having someone watch Caius. Okay, so y'all have you ever just like looked at your money and you're like, what the heck is K11? What the heck? Oh, they're all
Serial
K.
number?
Yeah, not the serial number, but here, let me. I think we did this last year in y'all's class. But we did with the dollar bill. I don't have a dollar bill today. Have you ever like noticed on your money there's like these numbers? On the dollar bill will be 4 different places. Does anybody have a dollar bill? Okay. On a dollar bill it'll be in the 4 areas. So I have K11, K11, and D4. So let me pull up. Alright, so I had one that was from K11. Guess where that money is from? Dallas. I had one from D4, but it's just 4. It's from Cleveland. Hey, all that money tells you is where these are. So if we look back at, let me look back at our money. Do y'all see how it says Federal Reserve Note? And this is one of the things that the Fed does, is they produce our paper money. Hey, they all originate at different banks. And so, let me go back to this. That is what these regional banks do. They produce this money, and they also then look at the other banks to make sure that they're operating safe. So the board of directors, what they do is they control the activities of the Fed. I know it says Ben Bernanke. I'm sorry, this is really old when I taught about it in Plano. The new guy that has been appointed by the Trump administration, let's put up the phone, is Jerome Powell. Okay? The Federal Open Market Committee, it controls the money supply. They set the interest rate through the buying and selling of government bonds. The Federal Advisory Committee, they provide advice to the president on financial problems currently going on. So the federal district level, we see they provide services for the commercial banks. They go into the commercial banks and they make sure that they are having the right amount of stuff in the reserve requirement. They provide services to the government. They pay the federal government expenses. They conduct the security auctions. And I don't know if y'all understand what security auctions are. The government basically prints out security bonds. They just print out these paper bonds. And when they print them out, what are they taking from you? Money. And so that also is a way that they increase the money supply or decrease the money supply. And so when they sell these papers, have they just increased the money supply? And we're going to look at a video that does this. And they also issue currency, which we just talked about. They also do check clearing. I don't know, how many of you ever written a check? I have to write them every single week. Huh? You've written a check. Hey, we just started having to write them because at church we just used to give cash. Did I ever tell y'all a story about, I'm recording this. Caius couldn't get baptized. And it's just like, it's something disheartening. We're Catholics. And we just didn't understand. When we were in McKinney, we just paid a $400 fee and he gets baptized. Or Callie got, yeah. And so in the Catholic Church, they were like, well, you don't have tithing. And we're like, what do you mean? We give every week. We just put cash in the little bucket. They were like, no, we don't have anything in an envelope from y'all saying y'all paid. They're like, I was like, you're serious? So my kid has to live in sin. They're like, yes, you have to have 6 months of tithing before he could be baptized. I was like, guess what? We're all going to live in sin for 6 more months. But we'll come to church and put our check in. So now.
You should just like hire a priest to come to your house and just like baptize him in the baptism.
But you have to understand, in the Catholic Church, you just can't hire a priest.
Yeah. Do your research.
Yeah. So now I'm faced with a problem that every week I have to write a check now so we could get Caius baptized. And it has to clear. And that's what they do. They take, every time I write a check, the bank, it's taken to the bank from St. Joseph's. St. Joseph's then runs it through their system and it clears. They make sure that I had the money, it was legitimate, and that money then goes to their account. And many of you are like, this is what a debit card does today, right? They take from one account to another. But before we had debit cards, it was actually before 9/11. We didn't have that many debit cards. People used to carry around cash. People used to carry around check. But after 9/11, you have to understand what happened on that day. Do you think they let any other planes take off that day? And so then all of a sudden, people who wrote checks, like I still write a check for our mortgage. It gets put in the mail, right? The mailman then puts it in his whole little conveyor of things, and then it goes in the air, right? To get to wherever our mortgage company is. So now think about this. Was my mortgage payment late if it was before 9/11? And the planes, yes. And now they had to realize that they needed to do something to have automatic check clearing, which is debit cards, right? But I don't know if you've ever been to H-E-B and you see someone write a check at the store. Have you ever been at H-E-B? They just don't put it in the little door. There's actually this little box that they run the check through, and it goes 3 or 4 times through, and then it clears. That automation happened because of 9/11. The whole demand for debit cards and them being able to be cleared at that moment, because used to be people would run a debit card or a credit card and they would put it on a little thing that would give an itemized receipt. But because 9/11, the Fed is now forced to do automatic clearing today, right? When y'all write a check to the school, do they automatically clear it today? No. But when you go into any realtor, like that's selling something, brick and mortar, it happens immediately. And that's because of 9/11, which was kind of scary, but it kind of improved our whole bank. Brick and mortar is like an actual facility. Because after 9/11, we're gonna see that a lot of people are buying online because of the dot-com boom, and that's what killed brick and mortar places. So like Walmart's, like the actual physical building. because of online, like the Amazon has killed
Yeah.
brick and mortar places. Okay. They also look at lending practices, which we know we had a crisis at 2005 because people were lending and doing those adjustable arms. Do y'all remember what an adjustable arm is? Remember when we talked about interest? Do you want to have fixed or an adjustable? Fixed, right? You want to get your dogs fixed so they don't reproduce, right? Because when they reproduce, you don't know how much. A flexible arm is going to go up and down, right, with the interest rate. And so they supervise those lending practices because we had a really bad crisis in 2005 with adjustable arms. They're the lender of last resort. Let's just say a bank gets in trouble. Usually they encourage them to go to another bank. But if they need the Fed will come in, just like in Harvey. They were the lender of last resort and they helped out people in Houston. They coordinate all regulatory activity. They coordinate the reserve balances. They send in the examiners to the banks to make sure that the banks are holding what they need to hold on hand. So again, the Fed, their whole thing is to have full employment, economic growth, and price stability. I know I've just done this, but we're going to watch a video about the Fed. And it's a cartoon video, but I promise it explains everything that I have just talked about the Fed.
Hi, I'm Buck, your personal tour guide to the Federal Reserve. I'm here to introduce you to one of the most complex but effective institutions in the United States. But don't worry, I'll explain it all in plain English. Just beside me is a roadmap of where we're going. Together, we'll walk through the Federal Reserve System, literally. And along the way, I'll show you just what goes on around here and why it's important. By the end of this tour, you too will be able to explain the Federal Reserve in plain English. As you can see, there's a lot going on around the Fed, but keep in mind that the whole is really just the sum of the parts. Basically, the Federal Reserve is made up of three parts. The Board of Governors, that's the building on the far left. The reserve banks, the 12 buildings along the right, and the Federal Open Market Committee. The complex design of these three parts is actually tied to how the Fed was created in the first place. To understand the structure better, let's first step back about 100 years. You've probably heard of the bank failures that occurred during the late 1800s and early 1900s. Back then, the failure of one bank often had a domino effect, in which customers of other banks rushed to withdraw funds from their own banks. These banking panics wreaked havoc, even on financially sound banks, and sometimes paved the way to serious widespread economic recessions. When Congress wrote the Federal Reserve Act in 1913, one objective of the Fed was to help banks acquire emergency cash reserves to meet such panic withdrawals, so that the shortage of funds at one bank didn't disrupt the entire banking system. This function would go a long way in establishing confidence in the banking system and more stability in the economy overall. Another goal of the Fed was to improve the efficiency of the national payment system by making it easier for payments, mostly checks, to be exchanged through different parts of the country. To achieve these goals, the Fed, then and now, combined centralized national authority through the Board of Governors, remember that on the map, with a healthy dose of regional independence through the reserve banks. A third entity, the Federal Open Market Committee, brings together the expertise of the first two in setting the nation's monetary policy. Okay, that was a mouthful. Let me see if I can make better sense of it. Let's take a walk through some of the places that make up the Fed, where you can see firsthand what exactly we do. I'm here now in Washington, D.C. Behind me is the Board of Governors, which is a U.S. government agency. The board has 7 members, called governors, who are appointed by the U.S. President and confirmed by the U.S. Senate. One thing the governors do is write the regulations that make commercial banks financially sound, and that make the nation economically strong. It's the governor's jobs, along with economists and support staff, to study trends in the economy and to help forecast the country's future economic direction. The governors also oversee those 12 reserve banks I showed you earlier. Probably the governor's most important responsibility, however, is participating on the Federal Open Market Committee, or FOMC. Speaking of the FOMC, the meeting room is right next door. Let's take a peek inside. I think a meeting is just wrapping up. Looks like we're right on time. Straight ahead is the FOMC, the Fed's chief body for monetary policy making. Here, the 7 governors from the Board of Governors meet with the presidents of the 12 reserve banks about 8 times a year to discuss the current state of the economy and how to promote steady and sustainable economic growth. While everyone here participates in the discussion, only the voting members actually vote on any actions that the FOMC can take to influence monetary policy. Oh, and when I say voting members, I mean the 7 board governors, plus the president of the Federal Reserve Bank of New York, and 4 other Reserve Bank presidents who serve on a rotating basis. As we've just seen, each FOMC meeting ends with a vote on actions that will affect the country's money supply. Not how much is printed, but how much money banks have to lend, which in turn affects the amount of money consumers and businesses have to spend. We'll talk about this more in a minute. Before we do, though, let's follow this Reserve Bank president back to the office to see what goes on there. Buckle up, we're headed west. In all, there are 12 districts in the Federal Reserve, and each is served by a regional reserve bank. Many also have 1 or more branches. As we'll see, reserve banks have 3 main responsibilities: providing financial services, contributing to monetary policy, and supervising commercial banks in their regions. Now don't worry if you didn't catch that the first time through. We'll take a look at each of these activities one by one. First, let's head to the financial services area and see why a reserve bank is often called the banker's bank. This floor is busy round the clock, which shouldn't surprise you. This is where the Fed's task of providing a safe and efficient method for transferring money throughout the banking system takes place. Every day, banks deposit billions of dollars at the Fed in cash, checks, wire transfers, or some other form of electronic payment for many of the same reasons we consumers use a bank. In addition, reserve banks offer payment services to all financial institutions in the United States, no matter what their size or location. For example, that fast-paced clicking sound you hear is a high-speed machine that sorts thousands of paper checks every minute and puts them into bundles to be rerouted to financial institutions. We've got machines like this that sort currency too. And over there, through the glass, you can see the computers that transfer money electronically from one bank to another. Companies offer these services as well, but the Fed is a primary player in the business. By the way, even though the Fed competes with other businesses in the financial services it provides, the Fed stays in the marketplace primarily to promote competition, innovation, and overall efficiency. Besides serving commercial banks, reserve banks also serve as banks for the U.S. government. We maintain accounts for the U.S. Treasury, process government checks, and assist the Treasury in issuing and redeeming securities. There's plenty more information about this on our website. It's getting noisy on this floor. Let's go visit the research department, where it's a little quieter. As you might guess, one of the most important jobs of the Fed is to keep our economy healthy. We do this by managing the nation's money supply, or what teachers call conducting monetary policy. This isn't easy to explain, but let me start by telling you what the economists do. Economists at reserve banks are all experts on different aspects of our national economy. These hang out in this department for a while, you'll notice that economists often hold firmly to their individual opinions and are known to debate their points of view with one another. Despite their varying perspectives, most economists agree, though, that the economy performs well when inflation is low and stable. As a result, low inflation is a long-term goal of the Fed. So, what do the economists do with their research? A lot of publishing and a lot of public speaking before all types of audiences. But their most important job is to prepare their Reserve Bank president for the FOMC meetings we poked our heads in on earlier. At the FOMC meetings, members together set a target interest rate called the federal funds rate, which is the interest rate on overnight loans between banks. This rate influences other interest rates, like those for mortgage loans, and greatly affects the direction of the economy. To hit the Fed funds rate target, the FOMC issues a directive to the New York Fed's domestic trading desk, which will then buy or sell U.S. government securities on the open market. You're going to have to trust me on this one, but ultimately, this action of buying or selling securities affects how much money banks have available to lend to you and your family or business, and thus either increases, decreases, or maintains the growth of the money supply in the banking system. Speaking of the banking system, let's tag along with this bank examiner, heading out to a commercial bank. To see what these guys do, you have to hit the road. As you might recall, Congress created the Federal Reserve to foster safe, sound, and competitive practices in the nation's banking system. To accomplish this, the Fed both regulates the banking system and supervises certain types of financial institutions. In case you're wondering, these types include state-chartered member banks, bank holding companies, which are the companies that own banks, and international organizations that do banking business in the United States. There are other types of banks that are supervised by other regulators. So, what's the difference between regulation and supervision? Bank regulation refers to the written rules that define what is acceptable behavior for financial institutions. The Board of Governors in Washington, D.C. takes care of this responsibility. Supervision refers to the enforcement of these rules, which is carried out by staff at the 12 reserve banks. Fed examiners, like those here, visit commercial banks and look over the bank's financial statements to evaluate the quality of assets, internal controls, and ability to manage risk. Now, why do you care? Because you've got money in this bank. The examiner's job is to make sure your money is safe and sound. Examiners also review a bank's performance in complying with federal and state laws. At the end of an on-site review, Fed examiners issue the bank a rating that reflects whether the institution is in good shape or whether it has weaknesses that require corrective action and close monitoring. One of the most important ways that the Fed ensures safety and soundness of the banking system is by helping banks respond to all kinds of crises. One way the Fed does this is by making short-term loans to banks through its discount window. This not only helps individual banks and their customers, but also ensures that a shortage of funds at one institution does not disrupt the flow of money and credit in the entire banking system. Well, here we are, at the end of our journey. I guess you could say the buck stops here. As promised, I've introduced you to the 3 big stops on the Fed tour: the Board of Governors, the FOMC, and one of the 12 reserve banks. I've also described our 3 main responsibilities: providing financial services, conducting monetary policy, and supervising banks. I hope my plain English style has helped you make sense of the complex yet effective design of the Federal Reserve System and how we contribute to a healthy economy. And hey, if you're ever near a reserve bank, don't forget to stop in and say hi. With all this savvy knowledge under your belt, I just may recruit you to give the next tour. Oh, and in the meantime, don't forget to visit our website for bonus features about the Federal Reserve. There, you'll find interactive games and other tools to learn about the Fed, including the publication in plain English, available in both a web and PDF format. Just go to www.federalreserveeducation.org and tell them Buck sent you.
Okay, so next time I'll probably do the questions with what we're gonna look at next is that reading that y'all will have to do. I don't know if y'all want me to go make like a second copy so you don't have to flip, cause what you have to do is on the back side. Do you want me to go make a second copy so y'all don't have to flip?
Whichever one you're more comfortable with.
Well, I don't know what y'all feel comfortable. You have to answer on the back side, but the information's on the front side. I'll make you another copy. I'll be back real quick. Cause this is what your homework's gonna be.